This is InvestTalk. Independent thinking, shared success. Justin Klein and Steve Peasley stand ready to take your finance and investment questions and share their unbiased answers. InvestTalk is made possible by KPP Financial, a registered investment advisor firm serving clients throughout the United States. The clarity for your path forward starts now. Here is KPP Chief Executive Officer, Financial Advisor, Justin Klein.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Wednesday, January 18th, 2023 edition. And we're moving fast through the third trading week of the year, and hope it has been good for all of you. And this is the time of year where most people reassess their current financial situation and plot maybe a slightly different path, or what worked over the last year, 3 years, 5 years, and what will work in the future. Both from an investment standpoint, which is what we talk about a lot here on the show, but also personally, career-wise, probably rethinking some things potentially, and then spending. What did you spend too much on? What wasn't worth it last year? What was? Sometimes, having money, spending your money is not always just about the total amount that you're spending, but what's the best bang for the buck? How much was wasted? How much was spent with good value and good impact on your life? That's something to think about as well. So this is a time of year where everyone's rethinking a lot of things, and the economy is constantly changing, the market's constantly changing, and you need to have a portfolio and a strategy that is balanced for you, balanced with your risk tolerance level, with your end goals in mind, and that's why we're here. So you've come to the right place to get that perspective and get the information that you need to be paying attention to. Now, that doesn't mean that every stock that someone calls in that I like is right for you, but it may be something you look into and assess for yourself. Get other opinions, do your own research, figure out, does that fit into your plan? If someone is older, retired, and is focused on income, but someone else calls up and is 25 and likes a particular company that's fast growing, small cap, it might not be appropriate for that older person who's focused on income. Now, that's an extreme, kind of two sides of the scale, but that's the way you need to think about this. You shouldn't be coming here with, I'm going to find that one good investment idea. It's more of the mindset. What am I focusing on, and how do I need to incrementally improve my financial situation? That could be a savings habit that we discuss on the show. Could be a spending habit that you need to improve on. Could be a simple investment philosophy that we espouse, which is down to earth, focusing on what is happening in the market and the economies today, not based on what you hope and wish the world to be, but how the world is. So I'm Justin Klein. I'm here on this radio program and podcast to help you make the most of your capital, of the money you have saved and are ready to invest. Help you make good money decisions consistently. So I look forward to this hour answering your finance and investment questions, and you can bring them to me anytime, 24 hours a day, 7 days a week at 888-99-CHART. I've got a lot of material to unpack for you today. One is our main focus point in regards to the Fed meeting coming up here in just a couple of weeks. It's February 1st, so I believe it's 2 weeks from today. Yeah, 2 weeks from today. And we are going to unpack what to expect and what that ultimately is likely to mean for markets. And then we're also, time permitted, going to dig into some other topics. One is in regards to big tech. They have realized they've come to Jesus moment with the NASDAQ down 33% last year. Many of their other large cap stocks down much more than that. And they've kind of talked about doing less stupid stuff. It sounds a little crude, but that's basically what they're talking about. So we're going to look at that story. Also, oil demand, the IEA, International Energy Agency, they came out with an updated guidance on oil demand for the globe. And then lastly, does China have a population problem? Is that an issue that is ultimately going to affect their economy? So we're going to look at that story as well. So those are the things that are on my docket, but ultimately it's about what is on your mind. So we're going to look at some voice bank questions. One is on Mueller Industries, MLI, and another is capital gains tax rates. So I have this all planned for this episode of InvestTalk, as well as your live calls at 888-99-CHART. Now, let's take a look at the market today. We had a down day, decidedly. The S&P was down 62 points, nearly 2% on the day, the worst day in a while. We had a nice start to the year overall, and you've had a retrenchment today, and this was the first major sell-off, and it was kind of what I've been expecting. I didn't get too bullish on the opening rally in the markets for the year. Part of the reason we rallied in the first week or two has to do with liquidity conditions, and oddly enough, the debt ceiling. I know it sounds weird. We're coming up against a debt ceiling, and you would think, well, that would be bad for markets. Well, actually, no, because what happens is when the Treasury issues debt, what they're actually doing is pulling liquidity out of the system. Now, in a time with QE, they were monetizing it. They were the ones buying that debt, so they weren't really pulling liquidity out of the system. Let's say that. But in the era of QT, they kind of are, and that's one of the reasons why you saw the market down for most of last year. Now, what's happening now is because the Treasury can't issue much debt, if at all, then they are spending out of their checkbook. It's called the Treasury General Account, and they're going out there spending money on all the things that the government spends money on, and that is actually infusing liquidity into the system. And so I know it's counterintuitive, but if you understand the machinations of our system, then you'll know that is one of the reasons why we had a nice rally to start the year. Now, we had some economic news today that came out, and it was definitely weaker than expected. Retail sales was actually down month over month, 1.15%, and that was after about a 1% drop the month before. Industrial production came out. That was negative 0.7% in December. That's even worse than the November number of about negative 0.6%. So you had a lot of data that showed a weak economy, and I think that's what the market's going to start focusing on. The inflation story, that's dead. That's long gone. That is a story of 2022. The story of 2023 is not going to be about inflation. It's going to be about the economy and how well it's going to hold up in the face of tighter liquidity conditions and a tighter Fed policy, right? Higher rates. So that's really the story today, and a big reason for the major sell-off. And I still expect the start of this year to be relatively choppy. Now we're heading into a break. Steve and I are happy to play your recorded voice bank questions, but we love taking your live calls as well. And our number never changes, and it never closes on InvestTalk. It's 888-99-CHART.
In today's world, a variety of factors are affecting the stock markets. Serious investors know building a secure financial future requires hard work and determination. That's why now, more than ever, when it comes to the planning, execution, and maintenance of your portfolio, you need InvestTalk. With total downloads nearing 50 million, each InvestTalk podcast should be one of your key financial planning and educational tools. InvestTalk is a free download, and hosts Justin Klein and Steve Peasley stand ready to provide their unbiased guidance and professional analysis developed from real-time data research and years of investing experience. 24/7, rain or shine, during smooth sailing or on rough weather days. The InvestTalk listener line is open and waiting for your questions. You set the agenda. Don't forget to call InvestTalk 888-99-CHART.
You've got finance and investment questions, and Justin Klein and Steve Peasley are ready with their unbiased answers. Don't forget to call InvestTalk 888-99-CHART.
Hi, Steve and Justin. This is Eric calling from Los Angeles. I appreciate your show and all you do. I've been a consistent listener for 6 or 7 years and really enjoyed it. I have a question for you today regarding Experian, one of the major credit bureaus. They use ticker EXPN on the London Exchange, I think EXPGY as in ADR. And I'm interested in picking up some shares here in the low to mid-30s. They've had some consistent revenue and earnings growth over the last several years, and they've weathered kind of previous recessions and the financial crisis fairly well. I'm interested in your thoughts on the company. Thanks. I'll be listening on the podcast.
All right, looking at Experian PLC. This is out of the UK, and they are a very profitable business. Return on equity right now is at about 26, which is below historical averages, right around 30%. So I like the profitability profile overall. The cash from operations right now about 1.8 billion trailing 12 months, which is right near an all-time high. And you're talking about a market cap around 34 billion, very minimal debt on net debt on its balance sheet, which is good. I like the low debt profile. Technicals that have rallied and certainly improving, but not an area that I would buy right now. You know, my biggest worry more is credit creation. You know, in a slowing global economy, there's typically less credit creation, and ultimately that means less demand for, you know, pulling credit scores and things like that. But this is really more of a play on, do you think that their profitability will continue? Do you think there's going to be, the companies like Upstart, for example, right? Upstart, I believe it's Upstart. Is it Upstart? Yeah, I believe they're the ones that has the analytics to inform lenders using different, AI and other proprietary services. And so, is a company like Upstart going to usurp the major credit agencies? And that's something I would be watching for. Now, Upstart is certainly cratered from $400 per share all the way down to $16, and they're struggling themselves. And maybe their hopes and dreams of usurping those major credit agencies has been a little overblown. Well, that's something that you have to have on the radar. But for Experian, it's a bit overbought. It's not necessarily cheap at the moment. I'd say it's fairly valued, but it's a good company. So overall, on a pullback back to the lows of late last year, I think that would be a good entry point for Experian. And I like what you're looking at, a company that is consistently profitable with low debt. But you got to keep an eye on things that could eventually disrupt that industry. Now, when people take the time to leave an InvestTalk podcast review on iTunes, I'd like to thank them for their courtesy by getting to their questions quickly. NX Ken says, I've been looking at Viper Energy, VNOM, for a while. I'm wondering if now would be a good time to start a position. So this is Viper Energy Partners LP. This is at a limited partnership. Remember that. You're getting a K1. That 6.3% dividend yield is taxed at your ordinary income tax rate. If you hold it within a tax-deferred account, there are tax issues that you need to be aware of. So that's the first caveat there. Now, what do? Well, they acquire and develop oil and natural gas properties in the Permian Basin in West Texas. So they are in the fracking business, and their business has been fairly up and down. $5 billion market cap. currently, and let me look at their debt profile. A lot of these limited partnerships have a lot of debt on their balance sheet. This one also has a lot of debt on its balance sheet. So I worry a bit about that. And enterprise value is 6.2, which is relatively cheap, but there's cheaper out there. So what I'm going to say is this is not up there in the top half, probably, of the type of oil exposures I would want. I want companies with lower debt that are paying dividends that are qualified and not part of a limited partnership and handing me a K1. I don't want that setup. And probably more diversified as well. I want a little more diversity than just the the Permian Basin. So, yeah, I'm going to pass on VNOM. I would look for others within the industry. Now, it's a fast-moving Wednesday. The market is consistently and constantly changing. So that means you have investment questions for me that you want answered. So give me a call now on InvestTalk at 888-99-CHART.
One of the most rewarding things I do each weekday is host the InvestTalk podcast. I truly enjoy helping investors, and I know that every question counts and every answer I provide will be unbiased. You, the caller, get to chart the course for each InvestTalk podcast. Call with your questions anytime, day or night, 888-99-CHART.
We're going to go over to Manhattan Beach, California, and talk to Nick looking at Microsoft.
Hi, Justin. Yeah, I'm calling about Microsoft with regards to ChatGPT. I'm sure you've heard of it. It's AI chatbot. It's taken the world by storm. It got 1 million users just within 5 days, which blows away, comparisons like Facebook or TikTok adoption. It's clearly very powerful. I personally, it's my go-to method of finding information now, just a month over. It's been released for about a month and a half now. I go to it versus Google for whatever I need, and I'm sure there's many people other like me. Microsoft has the exclusive rights to use it for business purposes, as they've invested about $1 billion to bring it to fruition. They are working pedal to the metal now to incorporate it into their Bing search, which we all sort of joke about. But if they do that successfully, I will be using Bing search as opposed to Google. And even if that eats in 5-10% of Google's search market share, that's a lot of money. And my question is, do you think this causes Microsoft to deserve a higher multiple and Google maybe a lesser multiple? And do you think it's a good reason to buy Microsoft going forward long term? Thanks.
Well, does it mean Google should have a lower multiple? Probably. You talked about potentially stealing some of its market share and its secret sauce, which is the go-to place to do searches. So if ChatGPT or an offshoot of it start to take away market share, that's certainly going to be impact Google. Now, how much Microsoft will really benefit directly. I think that depends on that partnership and all of that. And also, is it the technology behind it? Or is it simply the simple application of the technology? Because I expect, remember, AI, it's not one company investing in AI. And frankly, this is probably going to mean a rush of money trying to develop AI even further. But there are already other companies, including Google, that have been investing in AI. So, I think of IBM Watson, and do they utilize that AI to develop something similar to ChatGPT? And that's where I actually see this going. So I think it's less clear as to who will benefit ultimately and how much Microsoft itself will benefit. And I think has more to do with what's potential negative impact this could have on a company like Google. So that's the way I think about it. Now, it could be wrong, and I certainly need to dig a little bit more into how Microsoft will benefit overall. But I see this more as the start of the next phase of easily exploring the vast internet that has so much data, and this is one outshoot of the push towards AI. So yeah, that's the way I think about it. Is it a slam dunk that Microsoft is going to be the winner? I don't think it's a slam dunk, but they could be a partial winner along with likely many others. And Google ultimately would be it'd be to their detriment most of all, probably. All right. Thanks for the call. Now, my focus point concerns this question: as inflation slows, how might the market react to a quarter point rate increase? And now that we had this economic data today, you had the what was it? It was an inflation data. It was the PPI. There we go. Yeah, producer price index came in at 6.25 year over year, down from 7.35. The month over month was negative 5.5% after rising 0.17% in November. So it's pretty clear inflation is dead, and the markets are now pricing in a 95.8% chance of only a 25 basis point increase on February 1st. But what's even more interesting to me, because that's not really interesting, it's always been, for the last month or so, it's been about a 75+% chance that it would be a 25 basis point hike. A month ago it was 75. Exactly. So it's only risen slightly and more solidified that stance that the market was kind of already expecting anyway. What's most interesting to me, though, is that there's an increasing chance that this will be the last rate hike of this cycle, because their next meeting is on March 22nd, which is a ways away, end of this quarter, basically. And a week ago, the odds of a pause was 15%. Now it's up to 25%. So I think that's really the message here in my mind, and why the dollar isn't really rising very much from here. And you've had some Fed officials come out basically saying, yeah, 25 basis point hikes going forward are what's likely. But they're like trying to get over 5%. And after 25 basis points on the first, it'll only be at basically 4.5 to 4.75. And I think we're going to see, especially as data comes in, that this might be the last rate hike. Now we're heading into a break, but I'm ready for your live questions at 888-99-CHART. We've started the new year, and I thought it might be a good idea to let you know about a new way to make your meal preparations easier. If you are ready to get farm fresh, pre-portioned ingredients and seasonal recipes delivered right to your doorstep, HelloFresh was made for you. Now you can skip trips to the grocery store and count on HelloFresh to make home cooking easy, fun, and affordable. That's why it's America's #1 meal kit. With HelloFresh, eating well in the new year can be stress-free and delicious. With over 35 weekly recipes, they have the options you're looking for to help you achieve your goals. Choose Calorie Smart and Carb Smart recipes, or even customize select meals by swapping proteins or sides, upgrading your proteins, or adding protein to a veggie dish. When it's time for the game, you can home gate like a pro, with a limited time and winning assortment of snacks, appetizers, and shareable sweets available at HelloFresh Market. Treat friends and fans to delicious barbecue baby back ribs, chocolate chip brownies, and everything in between. We all want to save money this time of year, but did you know that HelloFresh helps you save money all year round? HelloFresh is less expensive than grocery shopping and 25% cheaper than takeout. I found that it's actually a pleasure to cook with HelloFresh, and I like to collaborate with my girlfriend as we try various HelloFresh recipes. We agree that eating well is top of mind, and it's comforting to know we always get top quality ingredients with HelloFresh. HelloFresh ingredients travel from the farm to your doorstep in under 7 days. That's how you know they are fresh. So, go to HelloFresh.com/invest21 and use code INVEST21 for 21 free meals plus free shipping. That's right. Go to HelloFresh.com/invest21 and use code INVEST21 for 21 free meals plus shipping. Try it, and you'll discover why HelloFresh is America's #1 meal kit.
If you're passionate about staying in shape and helping others stay fit, then perhaps it's time you opened your own fitness franchise. Body Fit Training is the one. This science-based, coach-led fitness model combines cardio with strength training resistance programs. Members train a different energy system and different muscle types every day with the ultimate goal of reducing body fat and creating lean muscle. BFT has changed lives and can change yours. Visit ownabft.com to inquire about franchise opportunities in your market.
Each day, InvestTalk listeners submit their finance and investment questions via phone or email. Would you like your question to be put near the top of the list? Just take a minute or two to leave a review and rating for InvestTalk at iTunes. And be sure to include a brief question with your iTunes review comments.
My question is about capital gains tax. Let's say I buy 10 shares of a company at $100 for each share on January 1st, so I've made a $1,000 investment. The company's share price has a nice gain over the calendar year of 50%, so the stock's at $150 at the end of the year, and I've now got $1,500. So a year later, I've got an unrealized gain of $500. Then I buy 10 more shares at $150, so I'm adding $1,500 to my position. So I now have $3,000, and my unrealized gain is still $500. My question is, if I now sell my position a few days later, and I have my $500 profit, am I taxed as short-term or long-term capital gains? I made my profit from holding the original position for over a year, but I'm now selling the entire position after only holding it in its entirety for a few days. I'm a little confused on this, and I hope that question makes sense. Look forward to hearing your answer on the podcast. Thanks.
Pretty easy answer here. There's what is called LIFO or FIFO. Now, if you ever take an accounting class, you'll know that what this is about. But it's last in, first out, or first in, first out. And you can set up the settings within your brokerage account. You just call your broker and you can set that up. And you can change it based on which positions you hold. But you basically have two lots here. You bought 10 shares at 100. You bought 10 shares at 150. Those are two different lots at two different dates. Now, standard is going to be last in, first out. So if you a year later sold 10 shares, you want to cut your position in half, it's going to default typically to the first position. FIFO, first in, first out, the first lot that you purchased. So it's going to sell those 10 shares of the first lot that you purchased at $100. Doesn't have to be. Once again, you can call your broker. You say, I want this to be a LIFO transaction, and I want to sell the last lot that I purchased. Okay, and that was at $150 per share. Depends how you want to do it. But your broker, you can set that up with your broker how which lot you want sold. Okay, but good question, because a lot of people don't know that. Which one does it trigger? Well, it's under your control. It's not like it just magically happens. Every broker does have a default, and it typically is FIFO, like I said, first in, first out. But you can change that. Thanks for the call. Now let's touch on how tech companies are starting to realize they were doing a lot of stupid stuff. And they were betting on moonshots. You know the term moonshots, right? Trying to just shoot for the moon. And tech companies are starting to take a more down-to-earth approach after they saw many of their stocks, including their own, fall dramatically. Its worst year, the NASDAQ had its worst year since 2008. And over 1,000 tech companies laid off employees last year. There were about 150,000 lost jobs within the sector. And so far this year already, there's 23,000 layoffs. Now, many of those workers were hired under assumptions of booming pandemic demand, and last year was a return to normal and a reversion to the mean. And that means a lot of those workers that were hired over the past couple of years are just not needed anymore. For example, Meta Platforms, their online advertising slumped, and their moonshot towards the metaverse fell on deaf ears with Wall Street. Amazon's coping with a slowdown in demand for physical products, and they're actually scaling back their spending on unprofitable businesses like Alexa electronic products. And in fact, some of them are giving a bit of a mea culpa. Meta, for example, did a blog post last month and said it's devoting 80% of its total investment dollars to improving its legacy business. Basically saying, yeah, we're still going to do things in the metaverse and invest there. But they were changing their investment strategy. And they want their projects to demonstrate value sooner than justifying to justify their high cash burn. So the message that Wall Street sent in a lot of ways was heard loud and clear, at least by Meta and many other companies. Google, for example, or Alphabet, they laid off more than 200 employees at its Verily life science unit, another 40 at its robotic software company, Intrinsic. And this is part of their other bets segment, which had a nearly $6 billion operating loss in the last 4 quarters and only generated $1 billion in revenue. That's not a good ROI. And even smaller companies like Redfin, they've stopped doing stupid stuff. and that's their words. That's the CEO's word, Glenn Kelman. He basically said that companies within the tech industry are stopping doing stupid stuff. Now, they laid off 13% of their staff, shut down their automated home flipping business. Zillow did something very similar, refocusing on their core business. And so that's what's happening within the space now. Is it's less about disruption and more about greasing the wheels of what got them there. And ultimately, this is called better allocation of capital. You know, when capital suddenly costs something, you get a little more choosy when it comes to what you're going to put that money towards. And when when the stock price goes up consistently, it's easy to say, oh, what we're doing is great. Wall Street loves it. Even though maybe long-term it's a bad decision. But when the price of their shares slumps so dramatically, it's a clear message that, hey, you're going the wrong direction. You need to right the ship, get back on track, and that's what you're seeing within the tech industry right now. Now let's swing back to the InvestTalk voice bank for a question that came in earlier from a listener in Germany.
Hello, Stephen Justin. This is Paulo from Germany calling. I'm looking at the stock, Mueller Industries. I've been onto them since many, many months, and I don't find the perfect entry point, and I actually don't like to buy stocks when they're like close to their 52-week top, so I'd like to have some margin of safety. When is there like a good time to buy this stock, or what would be a good entry point right now? Okay, thank you. Bye-bye.
All right, this is Mueller Industries. They make copper tubing fitting, brass copper alloy rods for the HVAC, refrigeration, and plumbing markets. And this company in 2022 was going gangbusters. Same with 2021. 2019, they only made $1.79. 2021, they made $8.25. Last year, once they report fourth quarter earnings, expected to be $11.25. But this year, earnings down 44% to $6.25. So you're starting to see that reversion to the mean, and that's why I wouldn't touch this yet. I have looked at this, and that was my trepidation. There's a lot of companies like this that pre-pandemic, they had a good business, but nothing amazing. And then suddenly some dynamics with shutdowns and lack of the supply or whatever the dynamics that COVID created helped their businesses. And now with the reopening, just like in the tech industry, just like in a lot of industries, there's a reversion to the mean happening. And where is that ultimately going to settle out at? And our view is most of these are going to return to pre-pandemic level of earnings, unless there's something permanent that has changed within the industry. And most of them have not. Most of it was more of a short-term anomaly. And so it's going to be $11 last year, $6 this year. What does that mean next year? Are we going to head back down to roughly $2 in earnings? If we do, this is drastically overvalued. And the technicals, we're making weaker highs here. And this recent move, it's made a lower high. And so I'm not liking any of the technicals here. It's something that we're watching to see where this levels out at, but nothing I would touch right now. So I can't give you a level because I don't know where these earnings are going to moderate towards. Is it going to sit around 6 for a while? And if it hangs around $6 per earnings for multiple years, and that's the new normal for this company, then it's on the cheaper side. If it's going to head back towards 2, it's drastically expensive. So I'm still in a wait and see mode on this one, and I would do the same. Well, there's no denying that we are in a new year and in a new environment in regards to markets. Just like that stock, there's a lot of mean reversion going on, a lot of confusion. What is the new normal? And that varies depending on sectors, depending on style factors, depending on the country you're investing in, etc. And this is a new era. And maybe you're embarking on a new strategy, maybe a new chapter in your life. Are you approaching retirement day? Guess what? It's going to hopefully come at some point. But the question is, are you prepared? Are you on the right path? Well, if you need help understanding your strategy and updating it based on your circumstances, I encourage you to reach out to myself or Steve Peasley at our company KPP Financial, where we operate with the same philosophy, which is independent thinking and shared success. And we practice unbiased guidance, both on and off air, and parallel investing, which means we invest right alongside our clients. So you can head over to investtalk.com and send a message to me and set up a free portfolio review assessment via telephone or GoToMeeting. Just head over there to investtalk.com or give our office a call at 800-557-5461. The sooner you contact us, the sooner we can help you get your portfolio optimized. Now let's go to Jacob in the Bay Area looking at Baxter.
Hey, Justin. Thanks for taking my call.
Of course.
So I'm looking at Baxter. I've been following it for a while. The chart looks terrible. It looks like it just continues to fall. But I work with a lot of their products. It seems like they make pretty good stuff. I was just calling to see what you guys thought of the company, and at what point you think it would be, where you think a good entry point would be.
Well, long term, I think the entry point is here. It's cheap. It's definitely cheap. But the question is, when is that going to ultimately turn around? Now, you had this acceleration to the downside over the past couple weeks, and a lot of times that means capitulation. So that could potentially be a catalyst there. But I would wait for an actual turn here. Technically, if you're looking for things to improve, for the right timing, then I would go with some sort of major reversal. But keep on your watch list because it is pretty cheap at these levels. Thanks for the call.
All right.
Now, here's another iTunes review question. Randall1951 says, I listen to other investing podcasts, but I always ask myself, quote, what would Steve and Justin say? Question mark, end quote. So thank you for continuing education. What sectors do you see providing the greatest value opportunity over the next 5 to 10 years? And I'm not opposed to growth opportunities, but I don't feel now is the day for growth stocks. You're correct, and I think this is a fairly easy answer for me. It is industrials. While the potential upside in the energy space is probably greater, I think the more clear-cut risk versus reward is industrials. Simply because we are reshoring manufacturing, and rebuilding supply chains here in North America. And that's going to take a lot of engineers and products that are going to build out that infrastructure, industrial products mainly. So if I'm picking one sector over the next 5 to 10 years, it's industrials all day. Thanks for the call. Now let's head over to another replay question now.
Hey, this is James from Georgia. I was trying to reach Justin or Steve. I had a question about Rent-A-Center, RCII is the ticker symbol. It's a recommended stock from Tip Ranks, and I was curious what your analysis is of this stock. Greatly appreciate your show, and I hope you'll have a great day. Thanks. Bye.
Rent-A-Center. I'm just trying to... Here it is. RCII. All right, let's pull this up here. This is a rent-to-own for appliances, computers, smartphones, furniture, etc. Business did really well during the pandemic and has retrenched considerably. Another one of those reversion to the mean type of businesses earned $2.24 pre-pandemic, earned $5.57 in 2021. Last year, expected to make $3.58, down 36%, and down another 9% in earnings expectations this year to $3.25. But analysts broadly are downgrading those earnings overall. Or earnings expectations overall. So I don't like that. When we look at its long-term profitability, it does tend to be pretty high, but I don't like the earnings trends here. And that's my biggest issue, is that continues to go down. And the payout ratio right now is 161%, so a bit high for my liking. And its dividend has been increasing, but it's starting to slow down here. The technicals, let me look at the technicals real quick. Yeah, it's still in a downtrend. I see nothing on the technicals that are getting me excited, so I'm passing on Rent-A-Center. Thanks for the call. This is InvestTalk. I'm Justin Klein, and we have one goal here, is to help you achieve your own version of financial freedom, and our work continues after this final break. So get your questions in now at 888-99-CHART.
You're building your financial future, but you must have finance and investment questions. Justin Klein and Steve Peasley are ready to provide their unbiased answers. So don't forget to call InvestTalk, 888-99-CHART.
We're going to go to Valencia, California, and talk to Richard looking at 3M.
Yeah, hi, Justin. Thanks again to you and Steve for always putting on great shows.
Appreciate it.
About maybe 4 or 5 months ago, actually, I called and spoke to Steve about 3M. And at the time, the stock was at about 128, and it had dropped considerably from its high. But at that time, Steve had said, still at no question, at that time, at 128, 3M was on sale. It's on sale at 128. Well, it has dropped a bit. Today, I think it's at about 122.5. And I know they've gone through, there's some lawsuit actions that I think are pending that I've heard. But what would you say, and I know how the environment changes, the investment landscape, but how would you say, what would you think of 3M at this price in terms of a buy and hold, where you put it in a drawer and just let it go, and it does have a dividend?
Yeah, well, there's different ways to think about that. Yeah, is it on the cheaper side of history? Yeah, its enterprise value to EBITDA right now is at about 8.5. Its longer term average is close to 13. And it bottomed, but it bottomed in 2009 at around 5.5. So it can be cheaper and can get cheaper. And the technicals, frankly, are saying it will get cheaper. So near term, I see more downside. And you add on top of that, like you said, that litigation in regards to its earplugs and the fact that it's still going to be liable for, some issues there, that is something that is an overhang on the stock, and along with a slowing economy, which it's an industrial company, it's well diversified, but its products are in less demand when the economy is slowing. And so, you have earnings expected to decline this year and next year. And so that's the issue. Now, not dramatic decline, but modest. And so, near term, I think it's going to go down. Longer term, I think it is on the cheaper side. So it just depends on what you're talking about. If you want to set it and forget it, fine. But know that you could probably get in maybe $100 per share, and that's at 122. I see no reason why it can't get to those levels, later this year or next year. So it depends on your time horizon, Richard. Does that make sense?
To get into a recession.
Well, we get into a recession, yeah. Like I said, it's business is going to continue to slow. You just see that right now. Revenue out. This is outside of the litigation issue. Revenue down 4% last quarter. Quarter before that, revenue was down 3% year over year. So I think you're still going to see a tough operating environment near term for a company like 3M. But it is a very good business. It is on the cheaper side of history. But near term, likely more downside. Thanks for the call. Now, lastly, let's touch on oil demand. And this is from the International Energy Agency, and they are lifting their expected demand for 2023 by about 200,000 barrels to 1.9 million more barrels in demand this year versus last year. And that's going to bring total oil demand for this year to average about 101.7 million barrels a day. And that's above pre-COVID levels and a record total amount. And so part of this, or the vast majority of this upgrade, has to do with China reopening. They're expecting about 15.9 million barrels in total this year to be needed for China, in addition to their demand from last year because of this reopening. And another part of this is Europe's economy is doing better than had been expected. So that's part of it as well. You're also seeing a higher demand for jet fuel and kerosene, similar to the growth that you saw last year because of aviation fuels demand going up. And the biggest risk to their outlook is that the China reopening will maybe a little bit bumpy, uneven. If you see surges in COVID, which you are right now, is that going to dampen demand near term? Probably, but overall, they're trying to reopen their economy. And ultimately, that means higher demand for oil. And with the supply growth still remaining subpar, that likely means higher oil prices this year. I'm Justin Klein. This completes another InvestTalk program. Steve Peasley and I thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And we just crossed over the 49 million download mark last night. Thanks to you. Independent thinking, shared success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of Klein, Pavlis, and Peasley Financial, a registered investment advisor firm which retains all rights.